So, good afternoon, everyone, and thank you for being here at the Valley School. Today, we have the pleasure of having here Mr. Pavel Begun. He's the co-founder of 3G Capital Management. It is an investment, a global value-based investment vehicle that achieved 12% return since inception in 2004 versus 6%, I think, for the MSCI ex-US. And together with his partner, Corinne Bailey, they manage around $100 million. So thank you for being with us today, Pavel.
It's a pleasure to be here.
Oh, thank you.
Okay, it works now. Yeah, it's a pleasure to be here. Thank you for having me.
Before we talk more about investments and philosophy, we wanted to know a little bit more about you. Can you explain your background and what did you study to become a portfolio manager?
Well, it's a long story, so I don't want to spend the entire evening talking about it, but as a brief background, I actually spent some time of my life being an entrepreneur. And probably since the age of 13, I founded and ran and sold 3 or 4 businesses in my native country of Belarus. And after that, I moved to the US, which is where I actually spent some time on the investment side of things. And I used to work as an analyst for A.J. Edwards and also Fiduciary Asset Management in St. Louis, Missouri. So that was the background that helped me to get started. And I think the benefit of having exposure to both the business side of things and the investment side of things is that, as Buffett says, you become a better investor by being a businessman, and you become a better businessman by being a better investor.
Yeah, that's great. And now going more into your philosophy, can you describe it very generally, and we can maybe after go into detail?
Yeah, sure. So basically, our philosophy is best described as looking for the 3 Gs, meaning good business, good management, and good price. And I know this sounds very generic. This is probably what everybody says. Nobody says, I'm looking for the 3 Bs, bad business, bad management, and bad price. But I think it's easier said than done. And I think we're probably going to be a bit more stringent about the execution with respect to those 3 Gs than most other people.
And going more into those 3 Gs, it's easy. I mean, good company is something everybody looks for, but how do you define a good company, a good business?
Sure. So with respect to good business, 3 defining characteristics as far as we're concerned. Number 1, we basically look for industry leaders, businesses that are simple and easy to understand, and we want to be sure that those businesses operate in industries where there is a long-term track record of leadership sustainability. So that gives us confidence to predict future cash flows. The second criteria is you have to have a business that generates high returns on invested capital, which we define as anywhere between 15 to 20% or higher. And thirdly, we want to be sure that those businesses are actually financially stable.
And having this in mind, is there any sector in which you historically have found good ideas or you tend to like?
It goes back to what we look for, i.e. we look for industries with a track record of leadership sustainability. So any sector where you see that, it's going to be something that we naturally going to be inclined to invest in. And some examples could be banking, could be consumer goods, consumer staples, mass market underwear. Conversely, we're going to stay away from industries where you do not have a track record of leadership sustainability. So an example of such industry could be, for example, fashion apparel. Because if you look at fashion apparel, what you see is that the leaders, the number 1s and number 2s, they generally tend to change over time. So they do not remain in the lead. So we stay away from industries like that.
Okay. Do you invest in technology now that you talked about, because it's a sector that we usually don't invest in, I guess that you either because it's very changing industry, but do you have any investments there?
Well, the answer is it depends. It depends on what kind of technology. If you're talking about a technology that changes rapidly, well then that's an issue because you're going to have no leadership sustainability in that kind of industry. But there are certain technologies where you don't see rapid changes in leadership over time, and those are the technology sectors where we would be comfortable with investing in. But like there are not that many of them, but if we do find one, we wouldn't be opposed to investing in it.
And the second G to your 3G
Yes.
philosophy is good management. That's very important. And first, what's good management for you? And second, how do you assess the quality of the management team?
Well, good management for us means managers who are both astute when it comes to operating the business and also skillful when it comes to capital allocation. We also want to be sure that they have the proper set of incentives, and ideally we want them to have skin in the game. So now if you were to go a bit deeper and to analyze how you actually tell if management teams possess those characteristics, what we do, we study track records very closely. So we're going to look at the operational track record of the business, and we're going to try to assess if management did the right things over time. And you can look at whether they're willing to sacrifice short-term profitability for long-term value. You're going to see if they improve their competitive position over time. You're probably going to try to analyze as to whether they created the right culture in the marketplace over time, things like that. When it comes to capital allocation, you're going to look at, again, at their track record of allocating capital. You're going to try to see what they did. Did they reinvest back in the core business, or did they strive away from their circle of competence? Did they return any excess cash back to the shareholders, either through buybacks or dividends, or did they just sit on it? So those are the things that we're going to study.
And on your 3G good price, how do you define good price? What's a good price for you?
Well, out of the 3Gs, this is by far the easiest element. And the first step for us is try to normalize earnings of a business and sort of calculate the earnings power that the business has when the economy is not too hot and not too cold and all the one-time items are removed. So once we do that, we'd like to buy those businesses at a multiple of anywhere between 4 and 10 times normalized earnings.
And in the value investing community, there is always this debate about either buying wonderful businesses at fair prices or buying fair businesses at wonderful prices. What do you think is the approach that is more similar to your philosophy?
Well, first of all, I'd like to say that you can probably generate good returns doing it both ways. Like you've seen Warren Buffett invest in good businesses over time, and he's done great. But he's also invested in mediocre businesses such as flour mills at really low multiples of earnings in places such as South Korea or Japan, and he's done just as well. With respect to what is more consistent with my sort of personal philosophy, well, I don't like compromises, so my philosophy would be good businesses at good prices. And, you know, people say that cannot be done. But if you don't have a lot in assets and you're willing to work hard and look for those ideas, eventually you do find those ideas that are actually going to be both good businesses, but also selling at very good prices as well.
And related to what you just said, it's very difficult to find the 3Gs. You're talking about good business, good price, and good management. If you find, for example, a company that has a good business and also is trading at a good price, but the management it's not so good, would you invest in that company by, for example, giving it a lower wage in your portfolio versus a company that fits in the 3G criteria, or you just don't invest in a company like this at all?
Well, it really depends. We're happy to glance over some minor imperfections, on one of the Gs if we get compensated by more perfection on the other two Gs. But there's a certain threshold and below which if we're just not going to invest. So let's say, you know, you have great business and you have a great price, and then if you have management that's not just okay but like really bad, we're just not going to buy it. We're just basically going to go on and find another one. They're just so much easier.
And also on price, I saw in your presentation that your portfolio is now trading at 6 times free cash flow. It's really, really cheap.
Yeah, it's like 5.5 times earnings and 7% dividend yield.
In the current market environment, where are you finding such that kind of ideas with such low multiples?
Well, we look around the world and we leave no stone unturned. And some of the regions are South Korea, China, Brazil, Russia, Eastern Europe, Turkey.
And in terms of sectors?
In terms of sectors, we have some banking, some consumer, we have some business services.
And can you share some specific ideas that you have at the moment?
Well, sure, but not all of them.
Yeah, I guess.
So one of the ideas is a bank out of Turkey called the Halk Bank. And the story is that this bank has one of the best deposit franchises in Turkey. It's part of an oligopoly that controls most of the country's deposits. The bank is very well run, generates very good returns on invested capital. It's in a very solid financial condition. It has a very conservative loan-to-deposit ratio. It's well capitalized, and it's selling for 50% of book value and about 3 times earnings. So that would be one idea. Another idea is a company called Silvano. It's a mass market underwear concern out of Estonia. They're actually the largest mass market underwear producer in Eastern Europe. And it's a very solid business because in that business, once you're number one in a market, you have so many important advantages versus the competition that you're going to generate very high returns on capital. I think they probably generate 25 to 30% returns on capital. They have a large excess cash position, no debt, double-digit dividend yield, and selling for a mid-single-digit multiple of earnings. And plus, they have 5% market share, even though they're number one in Eastern Europe. So the next biggest competitor maybe has 1% market share. So they have a really long growth runway. So that sort of gives you an idea as to where we're looking and what we're looking for.
And talking about banks, how do you? I saw also on some of your presentations that you like companies with conservative balance sheets, and you're averse to financial leverage. How do you reconcile that with investing in banks that are maybe the most leveraged businesses that exist?
Sure, that's a very interesting academic question, and I was waiting for somebody to ask me that. So finally. So I think there is a subtle but very important difference between bank leverage and general business leverage. And the difference is that with businesses, you're talking about credit leverage, with banks as deposit leverage. And the difference is that if you have a stressful situation in the marketplace, you can have banks pulling back credit leverage from pretty much everybody. So you're going to have like a huge contraction in credit leverage across the board. And to the extent that you're weak or strong as a business, doesn't matter, you're just going to lose that credit and you're going to be in trouble. Well, when it comes to banks, it's deposit leverage, which means that you're not really going to see a contraction in deposits. Like normally with deposits, what you see is you see the redistribution of deposits within the system, but you don't have a wholesale reduction of deposits across the system. The reason being, you're not going to take $1 million or €1 million out of the bank and put it on your mattress. You still got to have it somewhere. So the dynamic is that there is, in a time of stress, there is a flow from weaker players to the stronger players in terms of deposits. So the dynamic is such that as long as you stick with the stronger players, you're going to be fine. You're actually going to benefit from the leverage shifting. And if you own a bank that's weaker, well, yes, that's going to be a problem. But I guess the bottom line is, when you look for investing in banks, it's critical not to invest, not to compromise on quality.
And we usually avoided investing in banks outside Spain because it's a very local business. You have to know the macro well. You have to know how things work. What do you add being at Canada in a Turkish bank or a bank in another country?
Well, we spent a lot of time analyzing banks around the world. And basically, our goal was to be sure that our knowledge base, when it comes to, let's say, Turkish banking system or Chinese banking system or Brazilian banking system, is comparable to that of the local industry insiders. So we spent a lot of time developing confidence in basically the numbers, making sure that we know how things work. And as a result, we got comfortable assets and business values for those banks. And at the end of the day, banks are not hard to understand. Like, you don't need to be a rocket scientist. There are a few basic things that you need to know, but beyond that, you just have to be disciplined enough to be able to wait for the right price.
And talking a little bit more about banks, our analyst in Asia, Mingun Chan, told me to ask you this question. Given your long-term experience in banking, could you share your assessment on China banking system? He says he thinks the structure is similar to Turkey that you were talking about, where 5 big incumbents control the majority of deposits in economy growing at a decent rate, and the Hong Kong listed ones are trading at less than 1 times book. So what's your view on China banks?
The Chinese banking market is slightly different from the Turkish banking market. In Turkey, the Big 7 control 80% of deposits. In China, the Big 5 control probably 40% of deposits. So the Chinese market is quite a bit more fragmented. Plus, the Chinese market is also going to be a lot more regional. In Turkey, there is no such thing as a regional bank. They're all national and compete head-to-head nationally. In China, you have a lot of rural banks or city banks or provincial banks that are actually going to have very good competitive positions in their markets, even versus the Big 5. And that said, like in China, you can find some pretty decent banks. But again, unlike Turkey, the Chinese banking market is not as tightly regulated, probably a function of the fact that maybe it's a little less mature and also a lot more fragmented. So I'd say the regulation when it comes to the top 10 banks, it's probably going to be pretty solid. Once you start talking about smaller banks, there is a very wide dispersion when it comes to quality. And some smaller banks are going to be really good, and some are going to be really bad. And you always have to be super careful looking at the reported numbers, because a lot of times they just don't represent reality. So that's one thing to keep in mind. And also, I think in Turkey, across the system, those banks are much better capitalized than in China. So that's another factor to keep in mind. But again, in China, if you find a good bank at a good price, I think you'll do well if you buy it. You just have to be in China, there is a bit more beneath the surface than in Turkey.
And he also has another question that's not related to banks. What is your view on a company that holds too much cash? He says he found a lot of them in Japan and Korea. How do you value that excess cash? And he adds that isn't it value destroying when the interest rate is less than 1% while inflation is more than 2%, for example?
Yeah, it is value destroying for sure. Probably not as value destroying as just spending it on a bad acquisition, but still not the greatest. So the way we approach valuing that cash on the balance sheet is we look at a business and we say, does management have propensity to return that cash back to the shareholders over time? And if that happens, well, then you can probably exclude that cash for the purposes of evaluation and give management credit for it. Now, if you have a business where they sat on that cash for 20 years and didn't do anything, we just generally assign the value of 0 to that cash, because it's unlikely that as a shareholder you'll ever see it in your pocket.
Okay, and changing topics a little bit, what are your main sources of ideas? Do you do any kind of screening?
We don't really do any quantitative screens because we feel like you miss a lot, because business is a lot more than just numbers, and if you just focus on the numbers alone, you're probably going to disregard a lot of business that are really good and should be analyzed. So what we do instead, we basically take various countries' manuals, and we basically start at A and go all the way down to Z. That's how we found ideas in places like Brazil and Turkey. And if you are the countries, basically, you take that book that has all the publicly traded companies in that country, and you just go from page number 1 all the way down to the last page, and sometimes you find something, sometimes not. But I know it's not very scientific, but it works.
And can you explain more in detail your research process and how are you organized? Is it just you and your partner? Do you have a team of analysts, or how do you organize research?
Well, our team is basically 2 people, just my partner and I. And we feel like, the fewer people we have, the more we can preserve the core of the investment process that we have. And basically, I'd say, neither my partner nor I have a monopoly in decision making, and I'd like to say that basically the monopoly on decision making goes to fact finding and rational reasoning. So to the extent that either one of us can lay out a case based on solid facts and based on rational reasoning, there is not going to be a reason for the other person to disagree. And I think it's a function of the fact that between Corey and I, we look for something very specific, and we really see eye to eye when it comes to what we're looking for. Therefore, as long as both of us look at the same set of facts, we're probably going to arrive at the same conclusion.
And do you tend to disagree a lot, or or most decisions are based on consensus? And if not, does any one of you have the last word, or just you have to reach a consensus?
No, basically we both have to agree, but I think it again goes back to the fact that the facts are the facts, and if the reasoning is rational, well then you cannot not agree. So even if I don't like an idea that he brings to the table, but the facts are the facts, and his arguments are rational, I cannot refute them, well then we're gonna buy it.
I saw also in your presentation that you have a extensive network of on-the-ground contacts. Is it something proprietary, or is it something that you pay for? And if it's proprietary, how do you build that?
Well, it's not proprietary in the sense that they cannot talk to other people, right? So, I mean, they're happy to talk to whoever they want to talk, and we don't pay for it at all. It was just a matter of finding those people one by one, either through contacts, or sometimes it was just a cold call, and then developing a relationship and having those people help us familiarize ourselves with a lot of different industries around the world. One example I can give you is we were studying the Chinese banking industry a few months ago, and I found through contacts this fellow who is a Canadian, and he actually lives in China. He has lived in China for 15 years. And he's an auditor with the Big Four audit in Chinese banks. So, we try to find people like that because they're going to give you basically an insider view into Chinese banking. So to the extent there is something funny going on behind those balance sheets, well, he'll probably tell you. And once you talk to 5 people like that, well, I think you're not going to know quite a bit about how things work in China.
And talking about portfolio construction, how do you construct your portfolio? And also, I think it's quite concentrated. Why is that? And what's your view on diversification?
Sure. So I actually don't think 8 ideas is that concentrated. I mean, I'd like to run fewer than that, but I don't think it'd be sellable. But the reason that we stick with 8 and we don't go to 20 or 30 is because our investment criteria are so stringent that we simply would not be able to build a portfolio consisting of 20 names or something. So we basically stick with 8 for that reason.
And what's your approach to cash management in your portfolio? Is it an explicit decision you make, or is it a result of finding or not ideas that fit your criteria?
No, it's not really top down. It's a matter of the number of ideas that we're able to find, and ideally would like to be always fully invested, but sometimes we just don't have enough ideas that fit our stringent criteria, and then we have to be in cash.
And what do you think are the main risks that you face as a portfolio manager? And do you use any risk management tool, or just don't?
Well, in my mind, the biggest risk that we face as an asset management business is basically not having the time to play out your hand. And that's why we really try to make sure that we match the duration of the asset that we invest in with the duration of the deposit that we receive from our clients. And that's why we have a 2-year lockup, and you can only take money out once every 2 years, because we want to be sure that whoever invests with us has a positive experience over time. So that's the biggest risk. Aside from sort of the traditional risk management tools, we just don't think that sort of controlling volatility and things of that nature is really going to help you much in terms of real risk management. So our way of managing risk is making sure that we really do a good job analyzing all aspects of the business and management, and make sure that we buy things at a really low price. And this is the way to minimize risk as far as we see.
And I also saw on the presentation that you use industry and country exposure limits sometimes, I guess. How do you decide on those limits? Do you use any top-down approach, or is it something that comes up with the portfolio?
Well, there are no hard and fast rules on that front, because there are just way too many factors to have something sort of quantitatively simplistic. But I can tell you that we're just a lot more comfortable having a lot of money invested in countries that are large and stable, and a lot less comfortable having a lot of money invested in countries that are maybe smaller and not as stable.
And what do you think is the most difficult thing in your job, the main difficulty you face?
Well, the main difficulty, I think, is making sure that clients understand that this is a business where performance really should be measured over a 3 to 5 year stretch. As long as we can explain that they shouldn't be looking at quarterly numbers to assess us, well, our life is going to be easy. But if clients are going to be looking at our performance on a monthly basis, quarterly basis, our life is going to be hard. So we spend a lot of time on client education, making sure that they know that if they sign up with us, they got to give us 3 to 5 years before they, I guess, either give us applause or rotten tomatoes.
And now that you mentioned clients, can you explain us if an Spanish investor wants to invest in your fund, what can they do?
Well, they can talk to me, and I suppose I can tell them how the process works. As of right now, we only have a U.S. vehicle, but we're going to have a European vehicle probably in a few months. But we have a couple of Spanish investors, probably 2 or 3, and they somehow managed to invest in a U.S. vehicle, so I guess it probably can be done.
Okay, let's see if we have some questions from the audience.
Well, thanks for coming, Pavel. My question is, in the past you invest in Amore Pacific, so what's your view on the company now?
Well, my view hasn't changed. It's a very good business. The way I define it is sort of the Estee Lauder of South Korea. Very strong competitive position, obviously. In South Korea, I think they have top 4 out of the top 5 brand positions on the retail level. But at the same time, in terms of price, it's probably a little too pricey for us right now. I don't remember the exact price, but I don't think it's selling for 5 times earnings or anything like that. But who knows, at some point it might get cheap enough, and then we'll get a chance to buy it again.
do you hedge currency risk somehow? And if so, do you use any kind of derivatives for it?
For currency risk?
Yeah.
Well, that's another great question. Thank you. So this is where things get complicated because as I sort of studied how that works, I realized that if you use derivatives, first of all, it's going to be very expensive. And second of all, what happens is it's really going to be imperfect because there are a lot of different FX exposures within each business. So trying to decipher like what is it that you need to hedge in terms of specific amounts and currencies, like super complicated. So instead of doing that, we actually take a shortcut and we try to do implicit hedging, meaning we stick with businesses that are actually able to pass any negative impact of local currency depreciation onto the end customer such that the shareholders of that business remain protected. And a couple of specific examples. So we invested in this mass market underwear business in Estonia, and they have significant presence in places like Belarus, Russia, Ukraine, etc. So most people would say, well, that's currency risk, right? Well, the reality is in that business, all the underlying pricing actually takes place in euros. So anytime they ship product, they basically take the euro-based price, apply the going exchange rate, and ship the product. So the top line is effectively denominated in dollars. So as a dollar-based investor, there is really no currency risk. If anything, there is currency benefit because what happens is all the expenses are going to be denominated in the local currency. So if there is local currency depreciation and you have top line denominated in euros effectively, and yet expenses are denominated in the local currency, your margins are actually going to improve if there is local currency depreciation. So that's one example. Or you can look at the banks. Let's say you can look at, I don't know, you can look at like Russia or Turkey, and you can say, look, if I'm invested in a bank in that country, am I not going to be subject to currency risk? Well, the reality is that you aren't going to be because places like Turkey and Russia are highly dollarized economies, which means that anytime you have significant local currency depreciation, you're going to see a period of very high inflation following the depreciation. And that high inflation will actually serve to raise all the assets across the banking system back to their pre-depreciation dollar equivalent. Now, if we see a business where you don't have an implicit hedge like that, we're probably not going to be investing. But anytime we look for a business that's sort of outside the US dollar zone or the euro zone, we try to be sure that there is an implicit hedge like that.
Thank you, Pavel, for coming. A couple of questions. What is the average time that you stay in a company? If you are having a portfolio of 8 companies, normally how long you should stay? And what is the return that you are looking for when you invest in a company?
In terms of the expected holding period, it's normally anywhere between 3 to 5 years. Sometimes it's shorter, sometimes it's longer. There has been a company in our portfolio that we actually held for about 10 years. There's been a couple of cases where you buy something and then it just happens to like double in price or triple in price to get to intrinsic value like within a year or 2 years. Well, then I guess you have no choice but to sell it at that time. But we target 3 to 5 years. And what was that second question?
The return that when you are analyzing, what is the return that you are expecting from your investment? 2 times in 5 years, when you are analyzing that company. You mentioned that your portfolio is at 5 times PER or 7 times free cash flow yield, but to understand what is the target that you want to reach once you invest in a company.
Sure. So generally we target 15% IRR. But I think now we're probably expecting a bit more than that because historically we would normally buy things at maybe 8 to 9 times earnings, and we achieved a return before fees of about 13 to 15%. Now we're finding businesses that are a lot cheaper than that. We're finding some businesses that are 3 times or 4 times earnings. So I would expect our returns be quite a bit better in the future. Again, maybe 20%, but it's hard to give an exact number, but definitely better than the past, simply because our pricing is a lot more attractive today versus over the past 15 years.
Hi, Pavel. Thank you very much for coming. My question is, if you have had in some moment some value trap in your valuations, and can you explain what is the motive or the reason for the value trap?
Well, so I think the question is if we ever had any value traps, I guess, in our history.
Yes, please.
Well, I guess if you have a value trap, well, maybe it wasn't value to begin with. I guess that would be the way I would see it. So I'd say we had our share of mistakes where we would buy something and we thought it was worth X, and then it turned out that maybe it was worth half X. And you know, again, this is a mistake, but not really a value trap, because if you buy something that's worth X and that X keeps growing over time and you bought it at a reasonable price, you'll make money. So I think value trap has to do with the fact that maybe you made a mistake in your assessment. And you know, I probably had 2 or 3 mistakes where we just really missed it and we misjudged the economics of the business. But you know, nobody has a 100% betting average in this business, so we're happy to have probably 70%. That's as good as it gets for us.
And if you have a value trap, you sell it immediately? Or if you have a mistake in the process of research, you sell it immediately?
Yes, we do. I feel that I have to, because if you have a business and you thought that this business represents value based on the economics, well, then you realize that you got it all wrong and you don't really know what the economics are. Well, at that point, you don't really know what it's worth. So if you keep holding on to it, well, that would be speculation because you really have no idea what you have. So you're better off just selling it and moving on and finding something where you really know what the value is.
Hi, Pavel. One question. Do you think that the fact that you can invest in smaller companies makes the difference of your returns, and that you are finding good companies at good prices?
I think it makes a huge difference because if we're on, let's say, $10 billion or even $2 billion, we would not be able to invest in a lot of businesses that we're currently buying. So again, size is the enemy of performance. So I'd say once we get to 10 billion, it's going to get much more difficult. But in the meantime, I guess it's not that bad.
One question. Do you find any pattern in the opportunities you see of why they are cheap? Do you ask yourself that question? You mentioned the bank, why are they cheap, why others are not looking at it, and maybe also the Silvano fashion? Thank you.
Sure. So there is not one single pattern that I see, but rather multiple patterns. So it could be a number of different things. Sometimes people just get really pessimistic about sort of the geopolitical situation. Sometimes you have a bad economic environment, and that causes things to be cheap. And sometimes it's sort of company specific, where most people don't really have the depth of knowledge, and they make decisions to sell based on that knowledge that's really far from perfect. But that's our job, to make sure that we know why people are selling, and make sure that we're not buying something that people are selling for a good reason. I think a good check is to talk to other sort of intelligent people in that specific industry, not necessarily just investors, but just business people, and see what their take is and what their reasons are. And to the extent that you realize that, hey, I probably know a bit more than they do, well, you're going to have the confidence to stick with your investment.
Another question. If you had to choose between one key determinant being the price or the quality of the business, what do you think is the key determinant in your investment process? Do you prefer quality businesses even if they are more expensive, or the price is the big key element?
Well, ideal, I'd like to have both, but I guess if that's not an option, I'll go for quality. Because ultimately, even if you overpay for an asset, but the quality is good and you have good underlying growth in the intrinsic value, you're gonna make okay money. But if you buy something that's mediocre or on the way to decline or in the way to zero, even worse, and no matter what you pay for it, you're not gonna do well.
So I guess you don't like cyclical companies at all.
No, I'm not opposed to cyclical companies at all. Like I'm happy to buy cyclical companies. It just I want to be sure that I know what that normalized earnings number is. Like I don't have an issue with cyclicality. I mean, you look at ice cream business. Well, it's cyclical. You sell more ice cream in the summer than in the winter, but you know it's a great business. So, I think where I have an issue with is if you buy a business that's like in terminal decline, and you know it's going to be a zero in 5 years. Well, then maybe whatever price you pay for it is not really going to be enough to, I guess, to have you generate a good return.
Hi, Pavel. We have one question here from Twitter. Do you find value in Spain? Do you have any position in Spain right now?
Not right now. We don't have anything in Spain. I mean, we looked at a number of businesses in Spain, and we have them on our radar. And at some point, if they get cheap enough, we'll buy them. But who knows when that happens? You know, for like Silvano, I think I discovered that company back in 2005, and we bought it in 2014. So it took me, I guess, 9 years in the waiting, but eventually happened.
Okay, ask where if you want. Any name in Spain?
As far as the ones that I follow?
Yes.
Well, there is one called, I think, Viscofan.
Yes,
So,
right.
but like that's what everybody knows, I'm sure. So that's the one that I think is a pretty good quality business.
Thank you very much for coming. Two questions. If you had to choose 3 books that shaped your mind, not only your investment mind, but your general mind, and if you have any opinion about Markel?
Well, if we're going to set aside the investment books and talk about sort of just the books that I enjoyed reading in general, there's more than 3, but there's probably more like 300, but I'll try to stick with 3. So the one that I recently read and was very impressed with is a book by a Canadian psychology professor named Keith Stanovich. And the book is called What the Intelligence Tests Miss. It basically talks about the evolution of human intelligence and how that works with respect to rationality and how one can maximize intellectual output by being more rational. So that's one book. And there are a couple of good books about the evolution of the human race and why it happened. One is called Guns, Germs, and Steel by Jerry Diamond. And the other one is The Wealth of the Nations by David Landis, I believe, from Harvard. So like those 3 are pretty good. Again, not perfect, but they sort of just give you a very general idea about how sort of human race came out to be and why the nations developed the way they did. So that sort of probably give you some tools to make some predictions about the future. Oh, sorry. Yeah, Markel, I don't really know much about Markel. Like I know that the guy who runs it is very well respected. It's a very solid business. But last time I looked at it, I'd say, you know what, I can probably find better priced ideas. So unfortunately, not really sort of my circle of competence, so can't really tell you much more than that.
Okay, I have 3 questions. One is going back to a question that was made earlier on the in terms of your return, as you mentioned that you prefer investing in countries that are big and stable, and yet some of the examples that you've mentioned are Turkey, for example, countries at the moment aren't stable. So how much of that cheapness is because the country is under question, shall we say, and that you, in your analysis, it's whether that bank is going to do well, or because the market is finally going to recognize that it's not such a big deal, the political situation that is being priced into those low Ps. That would be the first question. The second one is, how important is it to your process to meet management as opposed to seeing how good management is via their public information or their historic track record and so on? And the last one is a more personal one. And has it been useful to you being a kind of outsider from my Belarus, I imagine, being in the States, if it gives you an outsider view to not taking the consensus view on countries or on companies? Thanks.
Sure, thank you for the questions. So the first one, I just wanted to clarify. So when I talked about country limits, I didn't really say that my preference is to invest in countries that are large and stable. Rather, I just said that other things being equal, we're more comfortable having more money in large and stable countries. So, we're not going to have 100% of our assets in Turkey, not even 50. So I think if you look at like Turkey or like Russia, Brazil, etc., I think what you realize is that over time, those countries do okay. They're probably not going to do as well as the United States, but they'll do okay. And you go through those periods of extreme optimism and extreme pessimism with respect to each of those countries. And if you look at Turkey, I don't know, 7, 8 years ago, back in 2006, I mean, the country faced prospects that really were not that different from where they are today. But people perceived Turkey as being a much better place to invest, and those banks were selling for 3 times book. Well, today, again, the trajectory of Turkey is pretty much the same as 10 years ago, yet those same banks are selling for half times book. Well, are they worth 3 times book? No. Are they worth half times book? No. They're probably somewhere in between. So I think it just gets back to the fact that if you buy it, if you think, well, your fair price is, 1.5 times book, you buy it for half times book, you'll probably do fine. And political upheaval in Turkey, well, that happens all the time. It just somehow now people are just a bit more up in arms about it, but that's why those assets are cheap. And then the second question was media management. I've done it a few times, and I frankly don't find it that useful. Because so you're gonna fly into Turkey, you're gonna meet with the CEO, and then it's like, okay, so the guy's wearing an expensive suit or a cheap suit. Is it good or bad? I don't know. He takes you to a branch. Well, it's small or maybe it's large. I don't know. Good, bad, who knows? So I just don't think you can really assess things that matter by just sort of looking at a few physical things and shaking the hand of a manager. But I think if you examine what they've done, if you examine their work, well, I think that's going to give you a great idea as to whether that they're good at what they do or not. And obviously, talking to people in the industry who know the work of those managers is also going to be useful, because to the extent there is something that's sort of beneath the surface, maybe not in the public domain, you're going to see that piece of the puzzle as well, which is, I think, important. And on the on being an outsider, well, that's funny that you say it. I had so many people ask me that question. So they're telling me, look, you were born in Belarus and now you're in the US. So like, probably that helps you because now you're like an outsider. I'm like, well, actually, you know what? Like even when I lived in Belarus, even when I was like 4 or 5, I always felt like an outsider, always. I just remember even in kindergarten, people always thought I was weird. So I was just always sort of doing my own thing, always off to the side. So I guess I come to believe it's probably genetic or something, because like my father is just like that. So, but I think it's helpful in value investing, right? Because you just really have to have more respect for your own analysis than for the general consensus, and it's just very hard to achieve that.
Dobry wieczór, Pavel.
Dobry wieczór.
I've got a couple of questions. The first one is, how was life for you in St. Louis? Because I used to live there as well, and I'm curious about it. And then, do you have any specific advice for those of us who are starting the field of investment research? Thank you.
Sure. So as far as St. Louis goes, actually I'm based in Toronto because I moved out of St. Louis back in '07.
I mean, in the past.
Yeah, in the past. So like it was okay. You know, work was fine. Life was, you know, I don't know. I want to say anything negative, so
I feel you.
I'm just gonna stay silent. So, you know, when it comes to advice, I'd say the biggest piece of advice I could give is if you can develop a track record, ideally an audited track record, that would be the most helpful thing that you can do, because it's going to help you with respect to two things. Number one, you're going to have a very objective metric, and you're really going to see, hey, I'm good at this, or maybe I'm not good at this and I got to do something else. And if you're good at this and you have an audited track record, what you're going to be able to do, you're going to be able to raise funds when you're ready to go to market and say, hey, you know what, I'm really good. Here's my track record, audited by, I don't know, KPMG or Deloitte, whatever. And that's going to be helpful in getting your business off the ground in the future.
Relating the good management rule, do you take into account the shareholder structure, such as family-owned businesses or big stake of insiders, and how would this would be affected in the case of HealthBank, the big public ownership that they have in the business, and this and the conflict of interest that this could originate?
Well, that's another great one. So I think when it comes to emerging markets, I think people get a little confused because they feel like, let's say with HealthBank, so you have the government of Turkey owning the controlling stake, and they feel like, okay, now the government of Turkey is going to tell them to make loans that are non-economic. Well, they used to do it back in the 90s, but they don't do it anymore, and there is a good reason for it. And the reason is, if you take a large systemically important bank and you force that bank to make non-economic loans, you're at risk of having your entire financial system go down, and if it goes down, the government goes down. So those guys who want to stay in power, they want to be sure that you're squeaky clean as a systemically important financial institution. So that's why if you look at HealthBank, they actually do a pretty good job running it for that very reason. And it's not specific to Turkey. If you look at a place like Russia and Sberbank, same thing. Like the Russian government makes sure that Sberbank is as clean as it can be, because they know that to the extent that there is a risk that Sberbank goes down, there goes the whole country. And same dynamic would apply to places in Brazil, et cetera, et cetera. If anything, I would say that anytime you have state ownership in emerging economy banks, you might have a slight advantage versus purely commercial banks, because in times of economic stress, you probably are going to be less likely subject to a bank run if you have a state owning a controlling stake in your business. If you think about it, you know, if I live in Turkey and there is a major economic turmoil, well, where do I keep my deposits? Do I keep my deposits in a commercial bank and who knows what happens to it, or do I keep my deposits at HealthBank because I know that the government is going to backstop that bank? And again, same dynamic in many other emerging markets. And then there is also a third pillar when it comes to sort of the state ownership dynamic of banks such as HealthBank or like Sberbank or maybe like banks in Brazil, meaning that if you're a purely commercial bank, there is always a risk that the private interests that control that bank might get into some kind of argument with the government, and as a result of that, the government will decide to punish those private interests, and as a minority shareholder, you're going to suffer. And there has been cases like that in Russia with UCOS back in 2002, and in Turkey with Asia Bank. So in both of those cases, you had purely commercial institutions, and you had minority interest or majority interest in those banks get into a tussle up with the governments, and as a result of that, those companies went down. and minority shareholders went down with them. If you have a stake in a bank that's majority controlled by the government, you don't have that risk.
One question. What has been your biggest investment failure, and what did you learn from it?
Well, there has been more than one.
The most, let's say, significant or remarkable.
Yes, but there is a pattern. So I'll start with one, and then I'll tell you about another two. So when it comes to investment mistakes, the investment mistake that I made when investing in Pier 1 is sort of like one of the bigger ones. Pier 1 is a home furnishing retailer in the United States. And the reason I even started looking at it is because I noticed that Lou Simpson, who used to run the insurance portfolio for Geico, who was basically really working for Buffett, he invested in Pier 1. So I sort of just maybe didn't do as deep of a research as I should have done, because I said, you know what, if Lou Simpson is buying it, it's basically the same as Buffett buying it, so you know what, you'll be fine. And of course, that's not how it played out. So competitively, that business, as I learned, was not as solid, and I learned my lessons on that one, which were helpful sort of going forward, but that was one mistake. And I guess there was another mistake of a similar nature, and this is where I'm saying there was a pattern to those mistakes. We invested in POSCO, again, because Buffett is invested in POSCO, Munger invested in POSCO through the Daily Journal. He spoke very highly of it, and we sort of maybe didn't go in as much depth as we should have, because we felt, well, you know what, there's the magic of the name. Those guys know what they're doing, speaking highly of them, and at the end of the day, we just realized that, hey, you know what, competitively, those are not solid businesses, so we didn't do too well in them. Now, we bought both businesses cheap, so we didn't lose a lot of money, but nevertheless, the lesson learned is that you have to do your own homework always, and don't assume that if Buffett bought it, it's going to turn out to be a great investment. Always has to be your own decision and your responsibility.
Another question, besides those most popular investors like Buffett, Munger, or Prem Batsa, which other do you admire the most, and why?
Well, I'd say Buffett and Munger are probably the two guys I admire the most. I guess there are a lot of people I follow, but in my eyes, they're not going to be nearly as good as either Buffett or Munger. But again, not to say that there is nothing to learn from them. I think there is something to learn from everybody, but I think Buffett and Munger, they're sort of sit alone atop that list.
Hi, Pavel. How often do you go to the Berkshire Hathaway annual meeting?
Well, actually, for the past 5 years, I've been going every year.
What's your what do you take from that meetings?
Well, I think it's an opportunity to learn more about not just investing, but about a lot of other things that are not related to investing. And if you listen to Buffett and Munger, obviously they comment in a wide range of topics. And I think that helps me sort of broaden my knowledge base and maybe identify some topics of interest that I'm going to pursue. And even though they might have nothing to do with investing, but I still enjoy, I guess, learning more about them and reading about them.
And the other question is, I read in this Value Investor Insight interview with you that you only allow investors to withdraw money once each 2 years. That's correct?
Yes, correct.
Why don't you let them to have more freedom to decide if they want to stay or they want to go? And if you launch the European version of your fund, will it have also this restriction?
Yeah, we will. Like if and when we launch the European fund, we'll have the same restriction. The reasoning behind is we don't want any investors to be disappointed. And let me explain. So if you have somebody give you money today, and then you invest on their behalf, and you invest with a 3 to 5 year time frame in mind, and let's say something happens in the next 2 quarters and you're down. So that investor might get scared, and he'll say, you know what, I'm going to take my money out and run. So he does that, he pulls out, he has a loss, so he's upset with us. Well, we're a little bit upset as well, and no one is happy, so why do it? If you lock them up for 2 years, well, at least we have the time to play it out of hand, and this way, 2 years later, he just emerges with, you know, a good return, and he says, you know what, yeah, I was scared in the meantime, but you know what, it all worked out fine. So we had great many cases where we had people who would give us money, and then after 1 or 2 bad quarters, they would say, oh my God, the world is going to hell in a handbasket, and we have to redeem. And then we just said, look, you cannot do it, it's lockup. Well then, you know what, over time they did just fine. And they were actually thankful to us that we did have a lockup, because they said, look, you saved us from ourselves. So, but again, doesn't work for everybody, and we're not trying to be all things for all people, so it just, you know, works for some people, doesn't work for others. That's fine.
And do you think that's appropriate to compare your track record with other funds that have daily or monthly liquidity, when you have this restriction that's good for your performance?
Well, I suppose if you told me that I have to run a fund based on daily liquidity, I probably wouldn't be able to do so well. But again, the actual numbers are the actual numbers, right? So, and I think you're probably right. I think what you're saying is that it's probably less competitive when it comes to long-term funds versus short-term funds, and you're right. But I guess our choice is to maybe compete in the market where it's easier to get a good return, where the market is less competitive.
Thank you.
Okay, if there are more questions, do you have more questions?
I have one question from YouTube. We have several questions about commodities. Can you have your opinion?
Well, that's a tough one. So I guess the question is, you know, whether investing in commodities is the right way to invest.
Yeah.
Frankly, I don't really have an opinion. I apologize. Probably not my cup of tea. I guess I can tell you that, like, in general, if you find a business that deals with commodities and it's a low-cost producer, it can still be a good business. But there are just not that many of those. So beyond that, don't really have anything good to say. I apologize.
Thank you.
I have maybe a last question. Here at Value School, one of our areas of focus is going to be behavioral finance. What personality traits do you think that are important to have when you are a portfolio manager?
Well, that's an interesting question, and that sort of goes back to some of the non-financial books that I read. So I'll add the fourth one to the list for the gentleman in the back row. So the book is called World Order by Henry Kissinger, who used to be a Secretary of State back in the 70s. So I think he once described the qualities that you need to have as a great statesman. So what he said is that he said, you need to be able to chart a course never traveled before, which takes intellect. And he also said that you need to have the ability to be able to stay on that road, even though it's going to be lonely at first, which takes courage. So I think those two traits would also apply to being a great investor. So I think you have to have the intellect to be able to figure out something that's fairly novel to you. And you also have to have the courage and sort of the emotional stamina to stick with it, even though this is going to be a very lonely decision, and you're probably going to be on the other side versus the general consensus.
Okay, thank you very much. I think we have another question, probably on behavioral finance.
Yes, my question is if you consider that the fund manager have it by own, or do you have to train and to know what is our irrational behavior in the investment?
So the question is whether it's sort of genetic or
Yes,
acquired
yes.
with respect to
And
ration.
if you know that you don't have the abilities, if you can train it.
Well, that's an interesting question. I was actually doing some research on the topic, and I think that book that I mentioned by Keith Stanovich, the professor of psychology from the University of Toronto, he explores that very topic. And I think what he found is that IQ, which is your raw intellectual power, is 70% genetic, but rationality and he's got a term for it, RQ, which is what actually required in the investment profession to sort of have that emotional stability. He found that RQ is actually something that's 30% genetic and 70% acquired. So I think you're probably going to have better luck trying to train yourself to be emotionally stable versus trying to be sort of smarter on an IQ level. So that's the answer for you. And actually in that book, he gives you some specific advice as to how you can maximize your intellectual output by being more rational. And like I think one thing that he specifically advises is to always invert, which is what actually Einstein always advised as well. So there you have it. But so it might be a good book to read, I guess. It actually discusses that very topic.
Okay, thank you very much for coming, and thank you for coming today. Thank you.
Thank you. Thank you for having me. Gracias.